Okay, so um, we can also do something that is maybe more informative. Is we first will do uh, a vertical analysis. Okay, so what is a vertical analysis? Um, Instead of going from years, we now just will take 1 year and do an analysis going up and down. And so what you will usually do is use your total revenue as the basis. Okay, so for example, this divided by, and I'm going to fix this cell. And I'm going to make these percentages. I think that will make it. So you can see here, everything is now a function of total revenue. Okay, so, and this is useful because, and for this top part, you can see what the percentage is between all the sources of revenue. You can see what the breakdown is. This this line item is 97%, 1.52, etc., to get to the total revenue. And then you can see how their expense structure breaks down. You can see that this is, as a percentage of the total revenue, the largest expense, which is the actual purchase of crude oil. Okay. And you can see that some of these are minor, and you can of course see it by the actual number, but this is giving you a better sense of the proportionality between the income statement. Okay, and also very importantly, it's giving you margins. Okay, so the income before income tax, which is you can consider this. Um, Actually, yeah, they give it their presentation is a little bit non-standard because they're first putting interest expense and then um, not giving a subtotal before that, because really this would be operating income, which is a standard kind of thing where it's basically your profit before interest, before tax, before any of the other miscellaneous stuff. It's just from the operations of the business. Okay, they're not giving that to you, but usually you would want that margin. Okay, that's an important margin because that is the margin without considering what country you're domiciled in, because that's going to affect your tax rate. It's not considering how you finance your business because that's going to affect interest expense. But they're not doing that, so it's okay. But this is, this income before income tax is an important margin to know too. Okay, this is like it's almost like operating income because you can see interest expense is very small. So they either have very low interest debt or not that much debt. And then you can see, of course, this is their net income margin. Okay, so this is after taxes, after all the duties, all the stuff they pay. This is their net income, and of course, they have some minority owners, and which is basically like minority shareholders, like of subsidiaries they own. So ExxonMobil owns probably thousands of other entities, but they combine all those entities into one combined financial statement, even though they may own like 80% of some other subsidiary. That 20% owner actually should get 20% of the net income from that subsidiary. So that's what this kind of minority interest is. It's a kind of a technical thing. You'll probably cover it in intermediate or advanced accounting. But basically, this is the net income for the shareholders of ExxonMobil. Okay, and you can see it's 8.7% of this total revenue. Okay, so for every $100 of revenue, they only have $8.50 of profit. Okay, everything else is going to taxes or expenses or whatever. If I did this for all the years, I could then look at how my margins are changing too. Okay, so let's see, because it's hard to tell whether my margins are going up or down just based on the numbers, right? That's why this is like a useful analysis. So let's see if our profitability, we know our number of dollars has gone down. We're making less money, but has our margin gone down? Let's see. So yes, you can see margins have also gone down. And then let's just do it for this last year. So yes, the trend is not in the good direction for ExxonMobil. Okay, the revenues are fluctuating. It went up the second year, but then down the third year. The margins are just declining every year. Okay, so maybe all those activists, like protesting outside ExxonMobil, are having an effect here. Okay, um, whatever the reason, there's probably some structural reason. We'd have to know. Again, this is when your industry understanding is going to play into this. Because I'm sure if you ask an oil and gas analyst why this is, we'll discern whether it's a structural thing in the oil and gas market or whether it's ExxonMobil as a company doing some dumb things. Okay, we can't really tell that just from this. We have to understand more about the context of the industry, ExxonMobil's business in more detail, what investments they've been making, where they're spending money, how do they stack up in their peers? Like, is there SG&A? Is this 3.35%? Is that too high or too low? How does that stack up against Chevron? Maybe Chevron is only 1.5% SG&A. So we don't know, because if you change this, if you lower this margin by like 1 or 2%, that's gonna significantly boost this. Okay, so we don't know where the mistake is for ExxonMobil. Maybe the Chevron's margins have shrunk even more as the oil and gas industry is going through some pains. Okay, so this is why financial statement analysis needs to be paired with your general business knowledge. It's not enough just to understand what's going on here. There is a larger context that this business is operating in. Okay, so any questions on, like, I think doing the technical, like making the analysis is pretty easy in Excel if you just know basically how to set up this formula, which is again the cell divided by the fixed basis, and you have to put those dollar signs. Okay, because look, the next one is the next cell down divided by that same B7. Same thing. Okay, and this one, of course, is that divided by that. And so if you just get this one formula right and just apply it to all the lines, you're kind of done with the analysis. Okay, so in MyLab, it will give you the financial statements. You go open up that little window, you say copy to clipboard or something, you paste it into Excel, and then you just do this formula and you're done. You just like copy and paste it to get the answer. This is again why I've been trying to encourage you all to use Excel. It makes this type of analysis, like, people used to have to do this by hand, like every number with a calculator. And they thought, when spreadsheets first came out, they thought accountants are going to disappear too. Okay, the balance sheet, you can do the same thing. Okay. Um, Again, the basis on the balance sheet is going to be total assets. So I just take this divided by total assets, make this a percent. Okay, so look, this is total liabilities and equity, 100%. Total assets, 100%. Why? Our accounting equation, assets equals liabilities plus equity. So the basis is assets, but it's also the same as liabilities plus equity. Okay. And now you can see how everything is divided up. You can see of their assets, property, plant, and equipment is by far the largest portion of their assets, and that's what you'd expect because ExxonMobil owns a bunch of property. Okay, they own all these oil fields all over the world. They're like a huge owner of assets. Okay, of these property assets. They also have refineries and like all the stuff, tankers, whatever. So it's quite obvious that they're going to be very heavily in PP&E. But you can also see, other inventories, notes receivable, accounts receivable. So, it gives you a sense of how their balance sheet is kind of broken out. What are the important assets to the business? And then, of course, one big piece of information here is this and this, right? You can see how they're financed. It's kind of like a 60-40 split. Interestingly, the reason why maybe they didn't have a lot of interest expense, most of this liability is current. Okay, these are probably trade payables. Okay, so they're not interest bearing. Okay, so though they have a lot of liabilities, the amount of long-term debt they have, this is the stuff that, like a bond that pays interest. It's like only 7.63% of of the size of the balance sheet. Okay, so they're using their vendors a lot. That's what this is. Okay, their vendors are giving them interest-free loans, essentially. Okay, and then I guess deferred income tax. So the American taxpayer, is also giving them liabilities. They owe the IRS a bunch of money through. They probably have some special tax advantages that they're taking advantage of, where they can defer tax. Okay, so and this is like an interest-free loan from the government. Like any tax that you owe, but you're allowed to pay in the future, you're essentially like that's like a loan, right? The government could have that money now, but they're letting you pay it later. So that's essentially like an interest-free loan. And of course, you could do this for the previous year, and you can see how everything is changing. Okay, and I'll just turn all these into percentages to make it more readable. Okay, so you can see that they've grown a little bit in PP&E. So they've probably they have net acquired more assets. You can see their current assets have dropped. So, if this is your company that you really know well, this information will be useful. You'll be able to, you'll probably come up with a bunch of questions of like, okay, well, what were the new assets they bought, and you'll read into the notes and see what they were doing in the year or the discussion. This analysis should also lead to a lot of questions of like, why is this happening? And that's going to force you to learn something about the business. Okay, so that's why this type of analysis is also useful. It's not gonna always answer questions. It's gonna usually lead to more inquiry.